Okay, hello everyone. Welcome to the accounting design project. Thanks Aon and Steve for organizing this great series of talks. I haven't been able to join the this talk much from online because of the time difference. I'm Jing Li, actually, from University of Hong Kong. So but I've been watching some YouTube videos. It's been great, very interesting talks. So I'm very happy to be moderator for Pierre today. And Pierre is Pierre Liang from Carnegie Mellon University, who is a very well-known theorist, has very broad interest of research. And I know Pierre recent years has been interested in this um, all understanding more about our basic accounting bookkeeping system from the graph perspective and network framework. So I'm very excited and also very eager to learn from Pierre's new project today, which is pattern recognition and the anomaly detection in bookkeeping data. Just a few just a few things to remind for the room today. Please mute yourself and turn on the videos for more active interactions among participants. And let's give Pierre first 5 minutes and last 5 minutes for uninterrupted time for presenting his research question and wrap the talk. If you have any questions, please raise your hands in the chat box so I can moderate the questions. And you can also type in your questions. So without further ado, time is yours, Pierre.
Great. Thanks, Jing, and thanks for the ADP organizers. I'm an amateur student of accounting thoughts, a history of accounting thoughts. So I'm very happy to see that ADP has returned to the normative roots of accounting research with a glorious past. So I'm very thrilled to have this chance to share with all of you some of what we have learned. I think it may have something to do with the ideal accounting design of this work on pattern recognition and anomaly detection, and by going back to our roots of double entry bookkeeping. And I look forward to chatting with all of you, especially with many friends, old and new. So unlike the papers that you may have seen me present in the past, this work is new in at least 3 dimensions. I would say that it has something to do with debits and credits mechanics with the deep roots in algebra and graph theory. It helps solve a practical problem that's repeatedly faced by accounting professionals in practice. We help solve them. We don't think we solved it. And it involves learning from computer scientists some fundamental theory of computer science, like minimum description length, which I'll spend some time on. Now, I want to acknowledge these accounting scholars, especially in CMU, that have influenced my thinking greatly. The great UG jury, with its lifelong passion for structure and mathematics of bookkeeping. I'm going to put John on the spot. John Glover, who works on double entry bookkeeping and linear algebra, to pique my interests in graphs. And of course, Jing Li, who co-authored with me on some linear algebra work on quadruple entry bookkeeping prior to the graph mining work that I later engaged. And then, of course, my co-authors. In writing this paper, my co-authors have taught me a great deal. Aluna, who's a former CMU doctoral student, for whom I have the great pleasure to work with for the last few years, and now she has joined HEC Paris and the AI lab there. And Christos, a computer scientist here at CMU, who has basically taught me almost everything I learned in this paper. And then Lamont Akligu, a faculty member here at Heinz and computer science, and her team, who has been my main collaborator and introduced me to the world of graph mining. All right, now let me warn you that this is an unusual presentation because the project is truly interdisciplinary, and it's a small part of what we've been engaged so far. For the most part, I plan to talk about a couple of specific examples or in computer science language or machine learning language use cases of pattern recognition and anomaly detection. But it's part of a much larger interdisciplinary project with the help of our industry partner, PwC. And then at the end, I hope I can share with you some broad lessons from what I learned, and then I'll try to tell you why this is so cool. Now, I'm afraid I may not get to the end, so I'm going to give you some high-level summaries of what we did. So our teams through the last couple of years figured out a way to leverage double entry bookkeeping to do a couple of tasks, recognizing patterns in the data and detecting anomalies. And what are these data we're talking about? These are large volume of transaction level journal entry data, which I'll give you snippets of later in the talk. And then the initial results that we've got is that we developed these what we call unsupervised learning algorithms to learn on the graph that we constructed from these journal entry data to detect anomalies in the real data and using tests to see how well they did. And it was quite effective. And then the second result that we did was we used the same algorithm, a similar algorithm, to try to quantify economic-based classification, because we have detailed general ledger information, so we can group them based on GAAP, FSLI classification, or something like economic-based, and we use Professor Penman's classification in his FSA book. And we actually are able to say something quantitative about that, and which is quite fascinating. And then the key to all of these results, in my mind, I want to take away is that there's something beautiful about double entry bookkeeping and visualized as graphs that's helping us to do this. In fact, computer scientists find our graphs very, very unique, very, very interesting, and they want to learn more about it. But what they contribute is this principle of in computer science called minimum description length, and that's something that I think putting these two things together is just wonderful. So that's, you know, if you want to take away something, this is I hope that can convince you. All right, so let me go to the first use case, which is the work on using graph mining tools. So this is from what I learned from Lemon Agligu, my co-principal investigator, to detect anomalies in bookkeeping data. So I'll spend quite a bit of time on this example and try to illustrate what we're trying to do here. So there are three main ingredients in my mind to make this thing work. The first ingredient is some really good data and some very practical problem from the field that has a big and practical impact. Now, anomaly detection is a big task. It's very pervasive, and it's extremely important in the real world to think about large volume of data and try to detect fake Amazon reviews or detect spam attacks in networks like the Verizon faces. So you name it, all right. The second ingredient is that we need some good theory. This is abstract theory, and this is from the domain knowledge, in this case, accounting. And now we go back to the royal and ancient mathematical theory of bookkeeping. That's the second ingredient. The third ingredient is that we need some toys. We need some really good technology, which is modern, right? So finally, these are modern graph mining tools. And so you need to have clever algorithm design and some powerful GPUs. So mix them together. I think it's really, really fun and cool. Okay, so let's go through each ingredient. So the first is that we need data and problem. That's definition from the field. Simply put, these data are large volume of transaction level journal entry data. And the problem is to rank these transactions according to how anonymous they appear to be, but using a computer algorithm. So inside organizations, most bookkeeping data are organized by journals and ledgers. So this is a general journal, which is on the top here. Give a listing of each and every transaction in a chronological order. So we're all accountants here, so we all know That's not the end, right? We're going to post them to ledgers, and that's the reason that the double entry bookkeeping system links all of these accounts together when journals are posted to ledgers. So all the ledgers are in some sense linked in the bottom here, where we have 2 accounts. And of course, in any reasonably sized entity, we have enormous amount of this data in journals and ledgers. In our most recent set of data, we have 17 million journal entries. So this is, this cannot be even stored. We have to store them kind of remote. This is too much detail for human beings to process efficiently in its raw form. Also, our industry partners want us to develop an algorithm to spot anomalies among these up to 17 million transactions. That's just for a year. So if you think about multiple years, that's huge. So let me give you a snippets of the data. So I was not able to post this in my paper because we're still under data use agreement. So I just want to share that here. So this is just a snippets of the real data. So these 2 lines represent a transaction. So let me just give you let me maybe zoom in on this a little bit. So this journal entry is identified by its journal ID, and then 2 accounts are affected. They are by account ID. We have a chart of accounts, so we can read off what these 2 accounts names are. And additional information are posted date, posted time, effective date, effective time, fiscal year, user, who approved it, who uses it. These are what we call metadata, right? The data about the entry. But the real entry are over here. There's a credit, there's a debit in US dollars, and by the same amount, right? So that's called relational data, right? This is how 2 accounts are linked. So we call these relational data as opposed to metadata, right? So among the endless entries, some contains error, simply just a mistake, but then some are potentially fraud or intentional error. So much of the internal and external auditing work has been to find a way to spot them. And it is very daunting. So generally only a few transactions gets to be sampled, and of course machine can help. So what is the problem? Problem definition is that we are to be given journal entry data, and we need to develop something in the middle, this blue part, and output from this needs to be a ranking of the same journal entries according to its anomaly ranking. So the highest score will have the most anomalies, right? So what is in the middle? We are asked to develop what's called a general, scalable, explainable, unsupervised detecting model. Why is it has to be general? General means it's not custom made. So we want a system that can work for GE and for Netflix, right? Scalable, that means the runtime cannot explode. You cannot go, if you go from 500 transactions to 1 million, the time cannot go exponential. It has to be explainable. You cannot just say this is a black box. I can tell you the computer says this is an anomaly. You have to be able to explain it. And it has to be unsupervised because we typically do not have labels, right? GE does not have a complete set of real errors in the data for us to train using a supervised learning. So it has to be unsupervised because you want to learn on the spot. Things change. And so what is our solution? The solution is data come in, it separates into 2 parts. One are the metadata. So who are the author, what are the dates and such. That go through a detector we call Complex, which is designed to detect categorical data items. And then the part that I'm going to focus on is the bottom, which are relational data. So these are debits and credits, which accounts there are, what's the direction. And we develop a new technology with the help of computer scientists. This is called co-detect. They have these cool names of their output. It's a new technology, and to give to detect transactions of its anomaly of the relational data. So and then we combine at the end the ranking into a combined ranking at the end. What they call reg aggregation. So if there's no questions, I want to just now describe how we develop co-detect. So I want to just pause to make sure that I've not lost many of you. All right. Okay, so how do we do this? So we have the problem, we have the data, now we need ingredients. So the first ingredient is theory. So we go back to the abstract bookkeeping theory. This is the second ingredient. So I told you I'm going to go back to the royal and ancient. So I'm going all the way to 1494, where Pacioli wrote his book Summa that described double entry bookkeeping. It was a math book, and it includes a description of double entry bookkeeping practice in Italy at the time, and as an example of application of linear algebra. And this is our connection to think about double entry as bookkeeping as graphs. Right. So journal entries looks very pedestrian, right? A lot of times entry-level clerk work on these things, but the theory is actually extremely deep. This is what fascinates UG. It's lifelong mystery. That's what he says. Because of the power of mathematical representation, right? So the same journal entry language can be equivalently represented using matrices. And some of you may know that linear algebra work by the Ohio State group, including John here, using matrices. And relevant to us, though, there is an equivalent a representation of the same journal entry or matrices using graphs. So how do we?
I think we have a question from Jeff McMillan. Do you want to raise up your question?
Yeah, I can ask the question. So my question is, maybe you'll get into this in later slides, so happy to sit tight. But the question would be, we have a concept of materiality in accounting, which I still think we're trying to figure out what materiality means. Yeah. But how does your algorithm, or have you thought about how your algorithm can incorporate some type of aspect of materiality?
Yeah, not yet. I think we're not there yet. I think there's a number of questions that could be asked. For example, the data was generated by a system that presumably has some kind of already materiality concerns, right? And then the question is, and then in the later downstream, this is going to be plugged into an audit system, like an internal audit or external audit system, and that may even need to confront the materiality. It's an excellent question, but it opens up for how our algorithm and how our graph representation can be deployed to either assist the front end or the back end.
Yeah, that's what I would probably suggest. Is the algorithm sounds really neat, but in to some extent, machine learning algorithms or artificial intelligence in general, at least at this point, is more augmenting human judgment.
Mm-hmm. Oh, of course.
And with materiality, I think it's hard to model that in an algorithm that can be portable across different entities. And so, but potentially just discussing that these types of judgments, because if you generated a list of all the anomalies, then the auditor can easily identify using their judgment which ones are material and immaterial.
Yeah, no, of course. In fact, the latest rounds of the problem definitions coming to us from the clients are precisely how human and algorithms, because they are deployed already in the field, right? In certain parts. So how human and machine interact is a very important issue. This problem per se has no human part of it, because it's designed to be, let's see what the machine can do. Very good question.
Thank you.
So what do we mean by representing journal entries as graphs? Here's a simple example. So we teach our students when a company books sales, credit sales, the journal entry should be debit receivable, credit sales revenue. This is actually a real entry. This is from our data. So this is it, and then you have debits and credits. So and the representation is simply taking accounts to be nodes and the entry at the edges, and the convention is debits is inflow and credits is outflow. And then for this simplest journal entry, these will be two accounts, become two nodes. And then there's an edge. If you follow the convention, this graph, little graph, 2 nodes, 1 edge with a direction, and then the dollar amount on it, that represents the journal entry. It gets more complicated if you have 3 debits and 1 credit in this case, because of sale tax and such. Then this is easily adaptable into a star-shaped graph. So very easy solution. But then more complicated journal entries when you have multiple debits, multiple credits, there's no direct link, like a compound journal entry, which we see a lot. So we need to work on it. So we have to develop graph construction solutions. There are several solutions that we have come up with, and then we can resolve it in many ways. And this is a particular way to resolve it. This is a kind of a sale of used equipment of some sort. Now so this is non-trivial, and the biggest, I think in our data, one of the biggest compound journal entries involves 65 nodes, 1,700 edges. And it's a machine-generated journal entry, of course. But that's what we come from, right? We need to audit it. So I just give you a sense that this is just 10 days worth of data. So if you just cut 10 days off and then create all the graphs and then impose them on the same graph, and this is what it looks like. Just 10 days. So this can get really big. The chart of accounts that we deal with was 500 to about 500 or so. So you have 500 different nodes, and million and up to 100,000 and up to millions edges. Okay, now we need tools. So the third ingredient is tools. These are data mining technologies, especially graph mining. And the specific tool that we use is an application of a principle in computer science called minimum description length, or MDL. Minimum description length, and it's used for pattern recognition and anomaly detection. So what is MDL? So there's a formal definition, very mathematical. So I want to give you a graphical illustration with an example. Ayan?
Yeah, I can wait after you talk about this. Yeah.
Okay, theory. Okay, so I just want to give you a simple intuition of what is the idea of MDL. So MDL is the idea is that there's something in phenomena that you want to describe. I want to find out the shortest, the minimum length of a description of it. So I'll give you the extreme example. And so for those of you who are into, if you use Mathematica or to learn, curious about computational biology, this is called Rule 30 of ECA. So this is called elementary cellular automata. And this is invented by Steve Wolfram. He's the inventor of Mathematica. Rule 30 is very famous, so you can Google it. It's a simple just eight purely deterministic instructions that tells an automata to generate the next row of cells from the initial condition of one row of cells. Okay, you go to the next cell. So for example, this white cell in the second row is generated from an instruction on the top, which says, if you see 3 white cells in the top, the next one is going to be white. And that's why it's called 0, right? 0 is white, and that's just binary. You can only be black and white here. And then this another cell, which is black, is following this 4th instruction that says, if you see a black and white on the top, you generate a black. And then there are only 8 possibilities, right? This is 2 to the 3. And then so you just specify, and this is rule 30. And the 30 comes from, if you look at this 8 instructions in base 2, if you convert them to base 10, it's 30. And rule 30 is very unique and very, very, very intriguing. That's what Stephen Wolfram found, is that after 15 rows of these self-generating processes, you see something like this, which is arbitrary. But if you plot 250 rows, which now it's orderless. In fact, this rule 30 satisfies the many definition of chaos, and it's actually used in Mathematica to generate random numbers. So which is amazing, right? This is 8 purely deterministic rules. So the pattern generated by this actually shows up in a lot of in nature. So seashells, a lot of nature is self-generating. So you can Google this. This is just beautiful. So what I want you to think about is to reverse the process. So suppose you're given this seashell or you're given this, right? And the idea is, how can you describe this in the shortest length, right? The shortest length has to be, in this case, we know it. It's this 8 instructions, very simple, right? Plus the initial condition, and that's it. That's the shortest description of this picture. So the minimum description length is the principle that says the best description or the best theory or the best model for something. One way you should look for it is for the shortest description length, and that's the basic idea. Okay, so generally for us, it's not as beautiful as this. Is that if you're confronted with some data, so for example, if you look at our primitive data, just a bunch of journal entries, right? The first task that we're going to do, if you want to follow minimum description length, is to decompose the data into 2 parts. One is called the M, which is the model, right? That's the M part. And then the other is the data given M. So you can think about the data M as a pattern sets or a dictionary. Sometimes we call it just a dictionary. And then the M is a restatement of the data using the new dictionary, right? So hopefully the dictionary is picked so that the description is easier. In other words, we want to describe the primitive data using the 2 man-made parts, right? Instead of restating the original data. So that now, how do I know the M is good, right? So what we do in this minimum description length is we convert the M into codes, into binary codes. And then same thing with the data given M, we convert them into code, and then we can measure how long it is for the code to describe these 2 objects, right? And now the constraint is that whoever reads the code needs to be able to reconstruct the data. So it's lossless encoding and lossless decoding. And then the optimization is to look for the M in such a way that minimizes the total description length. And that's the conceptual idea. So we look for language or look for a dictionary that help us describe the original data in a very, very efficient way. Okay. So that's the theory. Yes, Liang.
Okay, I think it's a better time to ask my question now. So I think my question is like, I think business environment has been very uncertain over the past couple of decades. So how much data or transaction level data and journal entries you need to actually have some scalable and stable model M?
Yeah, got it. So that's the thing. Remember going back to the paper, the original ask is that this has to be general, which means that we cannot have a pre-trained set of model. The model needs to be learned on the spot. Because things change so much, so you need to be able to look for patterns just from the data itself, as opposed to I have some old ideas about how the pattern should be. No. So that's actually a requirement that it needs to be learned in some sense immediately. And yes, so it won't. And I'll show you what I mean by that a little bit later. But it's there's a sense of we want to look for the pattern within the data that's given to us itself. We don't want to presume that there are some pattern. Yeah. Oh, so there are some pre-existing patterns. We hope there are patterns, but the patterns may not be exactly what we were thinking because the world has changed. Yeah. So.
Yeah. Okay.
Okay. So in our world, what is the M? What is the data given M? So I'm going to give you an illustration. So in our graph mining text, if we convert the transactions into a graph, like on the left that we need to describe, what is the M? So M in our case, because these graphs are high dimensional objects, these are not parametric, right? So we have to have non-parametric ways. So it's a table. So it's something table on the right, which is called motif table, MT. The motif table are 2 columns. On the left, it's these we call motifs, G1, G2, and G3. These are motifs. And the write is just a code that we assign to this motif. It's like a dictionary, right? If you see something on the left, and then we're going to write it as its code. And what are motifs? Motifs are simply substructures, or we can sometimes call subgraph, which can be used like parts, which combine with other motifs that we can combine them in some efficient way to describe something that we want. Right, so that's why I say what dictionary tells you, right? Dictionary is all the list of words and the meaning, and then you can use it to describe like Shakespeare's novels, right? So the same thing here, right? So the M is the motif table, like right. We need to search for the best one, and then when we confront a graph like left, we try to find a way to describe it using these motifs and therefore it's in codes, right? So for example, on the left here, we need to use like G2, right? Because there's A, B, and C with that direction. We need two of them perhaps. And then we need a G4 to describe the connection between C and B. So you need to have a nice motif table so that you can confront all the possible graphs that you see, like 17 million of them. So you need to have a very basic set of comprehensive motifs to be able to do it. And then the challenging task is to find the best one. So how do we find the best one? The best one is that we first convert all of the journal entries first into graphs. And then for any arbitrary motif table, we can convert them into a code. And then we can measure the length of that code. And then what we do is that we add up all of them, right? For a given motif table, we add up all of the length of all of the 17 million of them. And then we calculate the total length. And then we iterate over possible motif tables to find the motif table that gives us the shortest. And that's extremely challenging, right? This is a very, very hard problem. And so you have to have clever algorithm design, and that's why we need help by computer scientists. So that's what we did. Liang?
Yeah, what's the length of a motif? So like that's
so the length of the motif, the length of a motif is given by the table. So for example, let's think about a simple motif is suppose the company has a lot of credit sale transactions. So a motif could be simply the one that we saw earlier, right? A receivable and sales. And so if that happens a lot, I want to give it a very short code, right? Because the short code means that I can use very short distance to describe a lot of the data if the lot of the data is from credit sales, right? So here we use the Shannon-Fano coding, which is just using entropy essentially, entropy principle. Yeah.
So the length here
given by the
reflects the frequency of the transaction.
You can think of it as the frequency, right? So we assign the most frequent motifs shortest code.
Shortest code. Okay.
Yeah, exactly. So then the complicated transaction will have long code, and that's your anomaly. And that's just a use of this idea.
So I have another question is that once you find the optimal motif, most efficient, shortest table, can you present those motifs to auditors?
Yes, exactly, right? Exactly. Very good. Yeah. So in fact, our follow-up work is that they want us to look at motif tables from January to February to I mean, there's a lot of applications that you can do. Again, that's not our job, that's their job, right? Because we're done. Exactly. And it's fascinating looking at like motif tables. What are the basic...
And the frequency.
Yeah,
and
exactly.
Easily see that, the company never lease any assets. How come there's a motif looks like a lease transaction? Then that would be the anomaly. Okay. Thank you.
Exactly. Yeah. No, these are fascinating problems.
So we have
I think we have some questions. Yeah.
I'm just curious, if the ultimate goal, and I'm not sure it is the ultimate goal, but if the ultimate goal is to detect some sort of manipulation, maybe it's errors, maybe it's not manipulation, but if it's manipulation, how hard is it to come up with alternative schemes that involve more standard looking journal entries?
I know. John, this is actually it's very humbling. It's very humbling to see, right? So think about, there's several layers of this, right? So you design these, people will find out. People can run these codes too. So they know what kind of motif they are looking at. And also the unit of analysis that we have now is a single journal entry, right? We're looking for single journal entries anomaly score. but this is too primitive, right? So a typical fraud of misrepresentation does not involve just one. It's actually 2 or 3 or 4. And so our unit of analysis is not even at the level of the fraudsters, right? So then the idea is that you should be looking for a pair of transactions and 3s, and that's set of subsets. And set of subsets is huge, right? So if we have 17 million single journal entries, then if you look at all arbitrary pairs, that's crazy, right? So yes, one of the latest things that we're doing is actually graph neural network, which are more designed to do that kind of thing, as opposed to these compression-based stuff. We're at the ground floor. We're the level of the complexity is daunting. It's daunting. We just get started, I think. Yeah.
We have a question from Sudipta. You want me to ask? Or?
Yeah, I was just asking, haven't accountants been doing this for centuries by creating specialized books for frequent transactions?
Of course. A lot of what machines do is to replicate some wisdom, right? And even imperfectly so. So of course, right, frequent transactions, we learn, so in some sense, these motifs actually are used to explain things. So if there's something that we discover in the motifs that's outside the frequent transaction set, then then hopefully we can learn something. Or some frequent transactions are not in the set, in the motif, then there's something perhaps problematic about our approach. Yeah, no, that's the interaction we're looking for. Yeah.
Well, to go the extra step, in practice, the journals are used for the unusual transactions. Most of the frequent transactions are put in day books. So, I mean, there's already that sampling going on in practice. It's not just one journal that is used.
So we are given just the general journal, right, of an entity, the clients in some sense withhold a lot of domain knowledge just so that they can see how the machine can be pushed, and then ultimately they want to combine them in the way that they want to do. So these are very smart and strategic players, of course. So. All right, so
Pierre, I
yes.
have a question. So for those kind of transactions that's sort of for fraud, like you need multiple transactions to cooperate together, are you able to find a chain of transactions that appear repeatedly that might, because they usually hide a small amount and a lot of times, so are you able to link these together?
Yeah, so one thing, follow-up thing we're doing is to do this kind of dynamic graph mining tool. So far, what I described to you is like 1 year of data, and then we collapse 17 million on one graph. It's a huge graph and or graph database, and we just search for them with ignoring their timestamp on them, because in the metadata we have timestamp on these. So one of the things that if you think about the dynamic analysis, some of these chain of transactions may show up in when you do this in a month, every another week, and so those are the tools that still yet to be developed for us from our end. I think we, in some sense, another way to answer your question is that we need to exploit the fact that we not only have graphs that's regular but also dynamic. And there's a dynamic sequence of it, and that's important. And certain dates are very important, right? End of the month, end of the year. So there's a lot of domain things that can go in. Yeah. Very good question. Jeff, you have a question?
From Jeff.
I don't want to move on, but let me.
Just real quick, in terms of other metadata, does your data have the individual who's booking the transaction?
Yes, we have what's called a user. User is the individual that books, and then we have an approver who approves this. So those are very useful data for us.
Yeah. So similarly, if you're trying to detect management, you could use that metadata to figure out who's. Interesting.
Yeah, is it a Saturday night at 11 o'clock, that kind of thing? Yeah. So, Okay, so that's true. So let's suppose like Liang says, we find the best motif table, and so what you can do is a lot of what being proposed. Let's look at the regular. Let's look at the patterns and stuff each month or different divisions, and whether or not they are following the corporate instructions on the use of chart of accounts and stuff. Right, you can do a lot, but the specific ask for us is to use it to detect anomalies. So what we do is that once you find the best motif table, which means the most frequently frequent substructures of a journal entry are picked out, hopefully, and with a very short code, right? So then what we can do is that we can use this table to score every transaction by how long it is for the best table to describe it. So G1, G2, G3, and then the idea is that you look for the longest one. If the best motif table assigned a very long code to this transaction, at least it's a candidate that you need to look for. I mean, it's not that it's definitely something wrong or something really bad happens. At least there's a chance that this is that you should take a look. Okay, so of course this is the idea, and we developed this, but any model or theory or algorithm is only good when it delivers the results. So we were given a test data set. That means that we have never seen this before. And these are real data sets. So there are actual anomalies in them, but even our industry client may not know, right? So what they did is that they have their auditors that we didn't interact with inject 21 transactions, just very small amount into this data that of course we don't have the label, they do. And then they just want us to see whether or not we can spot them, how quickly we can spot them, right? How early. And we, I had no sense of how this do well, or how well this would do. So we did pretty well. I mean, to my surprise, in fact. So 17 out of the 21 showed up in the top 2% of the ranking, which means that you only have to go to 119. Sorry, 191 to get to the 17 out of the 21. And again, this is a conservative estimate. Remember, because this is real data, there's some anomalies that's actually in there, right? So that's not outside this 21. Okay, so so let me summarize. We managed, in some sense, to combine three things, right? We combine the century-old mathematical structure of bookkeeping, double entry, with modern computer science theory, which is minimum description length, and the tool, which is graph mining, and then help, right? Again, it's not completely solved, not at all, right? As we discussed, help at least some practical problems that's faced by our practitioners every day in internal and external auditing. So again, we're only at the beginning. This is the ground floor. This is, real auditing and accounting work is far more complex and far more sophisticated than the simple AI that we develop here. So that's my first example. So how am I doing on time? Oh, 15 minutes. Wow. Okay. So I get to do maybe my second use case. So if you indulge me, so let me go to the second use case.
Hi, Pierre.
Okay.
A very quick question. Yeah. I'm just very curious about from your first case. It sounds like it's from PwC, right, or an audit firm. So after they saw your results, I guess they are calculating how much kind of like manpower can be saved from replacing human auditors with this screening tool, right? This is just screening tool, but like I think like what Sudripa said is that exactly what human has done, but I think using human to actually go through this compared to your algorithm, I think algorithm will actually save more money in the long run. So have you heard anything anecdotally about the discussion about this replacement and how do we put a dollar amount or how much they think that this algorithm will be worth?
Believe me, they think, I mean, I don't think they explicitly tell it. We have these frequent meetings with them. You can see this is on their minds. Replace human labor. Yeah.
And a follow-up question is that as we are teaching undergraduate students, right? What should we teach them if your algorithm or other similar type of algorithm become very popular? Like, what do you see in the classroom?
I would say, in fact, I think we should teach them double entry. And so the reason is that we, you know, if this project taught me anything, is that we have a lot to offer, right? Our understanding of the accounting system, of how we organize our data, is instrumental. Like, so computer science cannot do without us at all. So I think to me, it's return to our fundamentals, right? Our understanding of internal organizational structure, about, you know, we have not even started on subledgers. So in fact, next year we're going to try to get subledger information. So understanding those, right, the exact process of record keeping, because your AI is only good as how well your data is prepared, how well the data is understood, right? So I would recommend going back and teach double entry and teach them well, right? To really understand, you know, how compound journal entry works, and the, you know, all, it's just anyway. I do want to move on. But
yeah. I think offline, I would love to see all the computer scientists' questions to you, right? Those are the
exactly.
For my teaching note. Yeah.
Okay, all right. So in the remaining time, I want to briefly describe our second use case. This is using graph summary. A question? Somebody?
Pierre, we have a comment from John and a question from Agnes.
Sure. Yeah, I just need 5 minutes, so that's great. Yeah.
Skip me. I let Agnes say something. I wrote what I wanted to say.
Okay. So I just curious that because of 17 discovered out of 21, I mean, there's still 4 missing case, and then we don't even know how material those 4 missing case is. And also you're saying this is a conservative estimate, maybe there are more you didn't discover or something. So I'm just wondering that, will this technique improve, like by learning, and then, you know, and so because originally you were saying that this model it should be improving, right, through learning. So I just want you to comment on that, if it's possible.
So yeah, we miss the 4 are there. It's just down the list. You have to go down a little further. And when I meant conservative, I meant it in the other way. I meant actually it's more than you see, because there are true anomalies that's not labeled. And so we need to look at the actual, like the top ranks, let's say that's not in the 21. But we actually should look at it because it's the real data, right? So to the extent we can catch those, I think we should.
Yeah, so I guess the question is kind of related to you know, usefulness of this, because of there's something that cannot discover, or, you know, like, of course you can kind of go down, but many things is like to save the cost. So just wondering that, you know, would that be taken into concern, you know, that will improve the discovery rate. That's all I'm saying.
Yeah. I think it depends on how this is deployed. I mean, this is to us, this is like this is just a kind of a toy model, right? Of trying to do this, because if you really want to, this is not for deploy. This is, I think we think of this as that this is R&D, right? This is R&D for the real thing that they actually want to deploy and actually market, and how to plug into the auditing teams, you know, planning, and then ongoing. And then and that's more. I think that's what you're asking. So, I think Sham has a question.
Yes, Pierre, you may have already said this, so I must have missed it. Can you tell us ex ante what is an anomaly here?
Yeah, this is actually a very, very long-standing debate in the anomaly detection community in computer science or in machine learning. What is anomaly exactly? So in this context, I think if you look at the theory, this is simply infrequent, right? In some sense, if you go down to it, it's infrequent in its structure, because what graph captures is the structural structure part of a journal entry. So we want to look for the subparts that make up any journal entry that's kind of rare. So that's a specific application here. But if you go to ML, there's a long debate about what is an anomaly. I totally agree. I don't have a good answer for you, but I have an answer within this context. Yeah.
Thank you.
Yeah, very, very important to know what the definition of things. Okay, so let me. I have 10 minutes. Okay, great. So let me. So John, do you want to say something? Okay. Oh. Thank you.
Oh, no, go ahead.
Thank you. Okay. Okay. So let me say my second use case. Second use case, the idea is that that we want to. This is a second project on graph summary. So we have a big graph, and so we want to. It's too much, right? Hundreds of nodes, lots of edges. It just cannot make sense of it. So let's try to reduce it in some way, and then make some sense, but not try to reduce too much so that we lose information. So the idea is about efficiently summarizing a large graph, a large set of transactions, and then. What do we mean by summary in the accounting context, right? In the accounting or bookkeeping. So now I'm going to use the information from the chart of accounts. Remember, when I show you the data, that's only the one page. There's another page which is much shorter, but it's very important. It lists for every account, distinct accounts, right? In the general ledger, not the subledger level, like the account a basic account list, and then they tell you the name of it. Right, this is a Citibank, a checking account, right? I use for payroll, right? Something like that, right? But then what also it gives us is different kind of classifications that accountants have put forth, mostly by GAAP, right? This is an asset. This is a liability, this is equity, and this is an expense, this is revenue, or this is a line item, what's called FSLI, so financial statement line item, right? This is cash and cash equivalents. So we have a hierarchy of classifications of the individual ledgers, right? So what we mean by that then is for any kind of a summary, like a summary means that we group all of the cash accounts, into a financial statement line item. So in the graph, basically you have 15 checking accounts, you collapse them into one, and hopefully that's if you do that for a lot of other accounts, you summarize. So that's what we're going. So we're going to bring in chart of accounts information. Okay, so what do we mean? So you take the transaction, right? This is 10 days. So you summarize it in one way by using, let's say, GAAP, FSLI, summary, and then it's a fun thing to do is that I taught FSA for many years, and I religiously use Steve's textbook, and so they taught us to use a different classification, right? Operating, financing, and short-term, long-term. So we call that. I gave it a name called EB. So we call it economically bookkeeping. So that's a second classification because we merge accounts differently. And then the minimum description length can tell us which one is a more efficient summary, right? That's the cool thing. We can quantify classification regimes and therefore aggregation regimes. So that's what we did. Okay, so let me illustrate, right? So what you do is that you take the data, and then you first get rid of all the edges and then just give you a lot of nodes. And then you bring in chart of accounts information to label them. And in computer science, it's called color. You give them different color. Right. So this is so the color can be, these are three. So it's A, L, and E, right? So so let me go. If you go to the chart of accounts, these are assets, these are liabilities, these are equity. And so these are three already, right? You can collapse the entire graph into 3 nodes, right? And then to see the edges among them. And then, of course, there's a lot of internal edges that you suppress, right? So that's a very small summary. It's a short summary, but it's very hard to decode back to the original graph. So you lose a lot of information. Okay, so FSLI would do. Sorry, let me just go back here. So this is just a way to group them or merge these nodes, merge these nodes, or merge these nodes. Or you can do better maybe you're not satisfied, you do this kind of notes, right? You put inventory accounts together, you put all of the, so you have 15 cash accounts, we group them together, or prepaid expenses. So this is according to FSLI, GAAP FSLI, right? And that's all given to us in the chart of accounts information. And then now let's try EB, what I call economic bookkeeping, which is basically inspired, entirely inherited by Professor Penman's teaching. So in fact, one of the computer scientists actually trained a little NLP model to predict what is the EB. It's quite interesting. So this is like short-term operating asset, long-term operating asset in this kind of grouping. All right. So here's what we found. We found that if you can score them, this is just very not surprise to me, but but I hope it's encouraging that that with some measurements, and the measurements is in the paper, but basically each classification we can measure how well they compress the data without losing information, and then so the key for a classification to do well is to organize transactions that's so similar that if you group them together, you don't lose a lot of information within them. And so the surprising thing to find out is that for all 3 data sets that we tried this on, EB, which is inspired by Professor Penman's classification, compressed the data better than GAAP, which is not a surprise to me, right? Because I've taught FSA but this is really in my mind quite exciting for this finding. So let's stop here. And then just to thank you for paying attention to me, and as a longtime accounting theorist working on partial equilibrium models on information economics, as you can see, I can find this exercise quite intriguing. It's very unusual. I hope you learned something from this, and I told you this is kind of an unusual talk. So I have 3 minutes. So I need to do my announcement, and then I will stick around to answer any questions that you have. So my announcement is in 2 weeks, my old friend and an old friend of Columbia, Bjorn, is going to share with us his thoughts on accounting-based valuation of inter-firm information transfer. Same time in 2 weeks. Okay. Thank you so much. And we have some extra time, and I'll be happy to answer any questions you have.
Thank you, Pierre. Thanks for your participation. We do learn a lot today. It's great to know all these advanced technologies.